If you want to invest in Bitcoin in a safe way, check out BlockFi by going to metkevin.com/BF and get up to $250 totally for free when you deposit money with BlockFi. They pay between 5 to 8% on different cryptocurrencies, so check it out, metkevin.com/BF, like BlockFi, and using that referral code is how you'll get that free $250 when you sign up and deposit money with BlockFi. How much you get depends on how much you deposit. metkevin.com/BF. The market this week felt horrible. In fact, many are considering it the start of a potential market crash. Well, here's what Cathie Wood has to say about what the heck is going on in this market. Now, as usual, remember, please don't sue me, bro. I'm just a dude making a video outlining what Cathie Wood thinks and trying to simplify what the heck it is that she's talking about and trying to save some time. So let's get into some of the bottom lines. First, Cathie Wood, in her video released yesterday, stated that we already know that bonds sold off this week due to concerns for inflation, Fed rate hikes, growth in the economy, and additional rounds of bonds being released to finance stimulus. If you need more clarity on this, type into YouTube, Meet Kevin, Why the Market Crashed Today, and look for my video from Thursday. But the big question right now is, what's next? Not what happened, what's next? Are yields going to continue to skyrocket, causing another stock market sell-off? Or was this a one-off? And are we good now? Can we just go back to investing and looking at our green tendies? Well, according to Cathie Wood, bonds are very heavily shorted and have been historically not shorted as highly as they are now. And that could have led to the latest sell-off that we're seeing in the market, especially what happened on Thursday. Because when bonds sell off, yields go up, and that's what spooked the stock market. Now, Cathie Wood actually believes that we might see a pause in yields going up because the amount of shorting in the bond market may now slow down after the catastrophe that we saw on Thursday. And this is a little bit tricky to wrap our heads around because we have to ask ourselves, okay, so bonds were shorted, so their prices went down, which meant their interest rate yield went up. And in order for prices to continue going down, maybe we'd need more people shorting them, but because yields are higher now, maybe less people are inclined to short them. So that's a theory, and that's kind of what Cathie Wood is outlining. In other words, saying, hey, right now we think there might be a pause in increasing interest rates in the bond market, which means a pause in the sell-off in the stock market. That's Cathie Wood's take. Now, Cathie Wood's take here, I have to say, a little tricky to really grasp onto. So I did a little bit of research and digging, and I came across this, which is actually the March 1st edition of the Barron's publication, even though technically it came out today on February 27th here, 2 days early. But that's how they publish these things. But anyway, this is an article, and I publish all of these, all my new research, by the way. I've got a new section in my Stocks and Money course where anytime I'm researching something, I'm going to be providing you exactly what I'm reading. So it's just a convenient extra way to, if you're looking for something to read what I'm reading. But anyway, what's interesting about this article here, scorched stock bulls learn bonds aren't so boring after all. In the article, they tell us a little bit more. First, they tell us what happened on Thursday wasn't so much that bond yields went up. It was, quote, the ferocity at which most of the action took place on Thursday. In other words, the rate at which yields went up, how quickly they spiked, that spooked the stock market, not necessarily that they did. And they mention that, quote, yet by week's end, it appeared the backup in treasury yields might have run its course, at least for now. They go on to say that the treasury market actually appears oversold right now, especially when we look at the relative strength index, the RSI, a very common technical that's used for trading. That really what the market might just be doing is trying to price in the fact that interest rates might be going up in the future. In other words, we're regularly fearful that, oh man, as soon as interest rates go up, the market might crash and pull back. Barron's is kind of saying, hey, we might start seeing that pricing in happening now. Because remember, the stock market tries to price in future terms. The stock market's trying to say, hey, let's price in what we think the market's going to be like in 18 months to 2 years. And so Barron's suggests, hey, you know what? This spike that we've seen recently could have been a short-term adjustment to, okay, yields went up. They went up at a fast rate. Great, we're done. We had our sell-off. We had our price in. Let's go back to normal now. And so Barron's and Cathie here kind of agree. And in my opinion, this is kind of neat because A, if rates go up, then maybe stocks won't crash as hard in the future because maybe we've already started pricing in that expectation. And B, if inflation doesn't end up coming around and rates don't end up going up, we could end up pricing out that risk, meaning stocks could go up even more. In other words, both Cathie and Barron's here are actually being kind of bullish after the madness that we saw on Thursday. And on Thursday, there was a lot of pain. On Thursday, I was doing everything I could to make sure all of y'all who support me and watch me on the channel or in the courses that I have linked down below, use that coupon code that's down there. But anyway, I was trying to do whatever I could to encourage, hey, this is a time to hold. This is a time to add. Buy the dip, right? Buy the dip. Anyway, the fact is that now here looking back, we've got Cathie Wood over at ARK Invest, obviously very popular, and Barron suggesting, hey, this is good. You know, we let some steam out of the market, but we think the pain is, at least for now, temporarily over. That's a good thing. It's bullish. Now, we don't want to stick our head in the sand and be stupid and go YOLO 100% on margin, but this is good to understand what their perspectives are. Now, Cathie's perspectives go a lot deeper when it comes to valuing, and she broke a lot of that down yesterday. And here's just a simple explanation. So, Cathie Wood believes that people generally expect a return of about 4 to 5% in the stock market. And therefore, if you take a very simple formula that she uses, which is simply the number 1 divided by the yield that you expect, you get a price to earnings ratio. And if you take 4 to 5, well, 1 divided by 4 to 5%, you would get a price to earnings ratio in the market of somewhere between 20 to 25. Which she says, okay, cool, like we tend to top out around 20 to 25, but wait a minute, what if the expectation that people have that the stock market is going to return on their money in the future declines to say 2 to 3%? Well, in theory, then price to earnings ratios could go as high as 33 to 50. Whereas in the past or in a down market, maybe we'd expect a 6 to 7% return on our money where PE ratios are like 14 to 16. Cathie Wood actually thinks the opposite might happen. That is, we could see average price to earnings ratios, multiples in the stock market, sitting around 33 to 55 as people demand less of a return on their money as we kind of stay and settle in a potentially lower interest rate environment, which is actually really bullish for stocks because right now there are a lot of individuals who look at the S&P's price to earnings ratio, for example, or the price to earnings ratio of companies, and we get confused because we're like, oh my gosh, everything feels so historically high. But if people's expectations of returns on their money go down, that is, they're willing to pay a higher price for the same share of earnings from companies, then maybe stocks aren't really overvalued. Now it just becomes a matter of more people are in the market because maybe more money was generated. After all, we say 25 to 30% of all money that's in the market now was generated in 2020, which is kind of weird to say. But anyway, if that's the case and people are looking and searching for returns, then maybe Cathie Wood is right. Maybe broader index funds are only going to return 2 to 3% compared to the old school 7% before reinvesting dividends because so many more people are chasing the same returns. And this is why Cathie Wood believes it's so important to laser focus on technology, innovation, and DNA and genomics. So here's Cathie Wood's kind of rationale for this. Cathie believes, and this is something she's been very consistent about, that legacy blue chip companies like GM, which she singled out, are so far behind the technology race that they're failing to realize the pace of innovation that's taking place, and once they finally get it, they're going to have to substantially cut the prices of their products in the future to even stand a chance at competing, and this will end up leading to a Ray Dalio style of deflation, which she views as bad, which is really where companies go through this great deleveraging by cutting prices to try to stay competitive to at the same time eliminate their debt before they can get consumed by their own debt. So this is where Cathie says the correct answer here in all of what we've just talked about is doubling down on innovation. And she turns the market drama of this last week on its head. She says, look, I've been down this road before. In fact, as recently as 2016 and 17, we had money in markets after Donald Trump's election shift to value plays and away from technology. She actually says that 2016 and 17 were very painful for ARK Invest because they invest so heavily in innovation and tech, but that's not what did well after Trump's election. Yet, Cathie Wood, and this is where you kind of go down the Cathie rabbit hole, and that's okay if you believe in her. Cathie Wood believes, hey, look, as long as money is expanding into these other sectors like value, which could end up being value traps, but hey, that's on other people. I'm not investing there, as she says. Anyway, the more money invests into these other areas, the better it actually is for technology and innovation, because as more money spreads into these other, in her opinion, lower growth areas, then in the future, as technology and innovation show, this is where the game is, this is where the money is being made, you want to be in innovation and tech, then money might actually flow from value in other sectors back into tech, genomics, and innovation, and actually end up leading to outsized returns in those sectors, much like what we saw in 2019 and 2020 with Tesla and tech. So, in other words, Cathie Wood is turning around what happened this week completely on its head and saying, hey, this whole correction that happened the last week, first of all, called it. She did say in January, hats off to her, that we should prepare for some form of a correction this year. She said she didn't know when, but that you should always be prepared for it. So hats off. She's correct. But what she's also saying is, hey, look, buy the dip. Get in on technology and innovation during these times when people are distracted by maybe what plays that appear to be value plays but could end up being value traps, or even index funds, which she is deathly opposed to. Maybe not deathly, but she's not very excited about index funds. Anyway, and maybe, who knows, maybe there's a bias at play here because she does run an actively managed ETF, exchange traded fund, which basically means you can invest in her actively managed fund by buying shares in things like ARK-K, ARK-G, ARK-W, and so on. Now, when it comes to interest rates, Cathie Wood believes that there are two trajectories for interest rates and what the Federal Reserve might do. She believes that the Fed will either raise rates sooner to combat potential inflation, that potentially Jerome Powell is going to have to U-turn on his argument that we're not going to raise rates until 2024. This, by the way, is a scenario that I kind of disagree with personally. I kind of think that Jerome is going to stick to his guns and we're not going to see the Fed raise rates until 2024, but you can't always be 100% in on something. You have to be open to all possible scenarios. But anyway, she believes that the Fed's going to change trajectories and they're going to end up raising rates sooner rather than later. And that's one of the reasons she is bullish on Bitcoin. But it's also one of her explanations for, well, that is why we might potentially see some volatility in stocks like the tech sector, genomics sector, as the market begins to price in rates, which we just saw in this last week. Now, there is a flip side, though, and this is the side that I'm a little bit more inclined to believe in, and this is the side that Cathie Wood also addresses, which is very important because it totally makes sense. And this has to do with the decline in the velocity of money. So this is something we've gone deep on as well before on this channel, but the easiest way to explain the velocity of money and to kind of show this alternate scenario. So if scenario number one is Fed changes their opinion, they raise rates sooner than expected, then scenario number two is the Fed doesn't raise rates, right? We go with the more like Kevin Fed strategy of let's wait until 2024. And again, I'm not trying to align myself 100% with one direction. I'm just leaning more towards I don't think the Fed's going to raise rates anytime soon. Anyway, in that scenario, which Cathie Wood addresses, she believes the velocity of money can stay low, and maybe we don't actually have to raise rates. And here's an easy example for this. Let's say there are 100 of us in a classroom. So kind of think about it like a college lecture hall, okay? So there are 100 of us in a classroom. Let's say every single one of us has $1 billion. That is, one of these little pieces of paper right here represents $1 billion. Now let's say we all buy something from each other 10 times. In other words, I buy you, or I buy a cup of coffee from you for $1 billion, then you take my $1 billion and you go buy, I don't know, toilet paper for $1 billion, whatever. The point is, all of our money circulates in our little economy in this lecture hall 10 times. So now we've kind of created this lecture hall economy. Well, if we have 100 people and our money exchanges hands 10 times and we each have $1 billion, then we take 100 billion times 10 and we have a $1 trillion economy. Okay, cool. Well, now let's say we get somebody like Mr. J. Powell, and he's got a money printer, and he walks in the room as a substitute teacher for the day, and he cranks out, what Jerome Powell cranks. cold hard cash. What else? And he doubles the money we all have. So all of a sudden now, instead of having $1 billion, we actually have $2 billion, which means we've doubled the amount of money that we have, which means in theory, instead of just buying one coffee, I could buy twice as many coffees. And if I were to buy twice as many coffees, the price of that coffee might go up because there might be so much more demand on coffee. The price of coffee might go up, which means there might be inflation. But what if maybe I double my money, but now I go ahead and save and invest the other half and maybe even a little bit more, and I actually only circulate like 700 million of my $1 billion instead of the full $2 billion or even the full $1 billion that I had before. And now I'm actually exchanging less money that's circulating. Well, now, even though we've printed more money, our economy has actually, in this more extreme example here, shrunk. Our economy went from a $1 trillion economy to us each only circulating $700 million, meaning we've gone to a $700 billion economy. So we actually had a decline in GDP, which means less demand for products and services, which means potentially less pressure on inflation, which means prices could actually come down, despite the fact that we now have way more money. And that's a very real possibility, because this is something that I've mentioned often on this channel during this pandemic is, in my opinion, we could be going into something that I call the Frugal Decade, which is where we actually save and invest more than we spend. It's kind of like what I showed here, where sure, we have maybe more money, but we save and invest this, and then, we don't need to spend this. We just don't need to spend that much money. Let's put that away. We still got money to spend. We're still going to go on vacations and stuff. We're still going to have a reopening boom. But if the velocity of money goes down, inflation might not actually happen. And if inflation doesn't actually happen, then the Fed won't have to raise rates as much and they can continue to fight unemployment, which is their goal, after all. That is a part of their dual mandate, and arguably it is one of the most important parts of their dual mandate: price stability and unemployment, and we want to see unemployment as low as possible. So, in other words, Cathie Wood is bullish in an environment where rates go up because she believes in innovation. But she's also bullish in an environment where rates stay low, because if rates stay low, well, that's just going to keep pumping money into the stock market anyway. And so no matter how you slice the inflation debate, Cathie Wood is like, look, tech and innovation, okay? Like, how many different times am I going to have to explain the same freaking thing, tech and innovation, okay? And one of the reasons she's so bullish on tech and innovation is because she believes that electric vehicle companies become more efficient for every doubling of output. And this is kind of interesting. She says, look, when the EV industry doubles their output, they become 28% more efficient every time they double. 28%, 28%, 28%. Now, I'm sure there's some kind of declining scale to that, but still that doubling in efficiency, huge, because that means profits. That means tendies. Yes, and we all like tendies. In the DNA sequencing industries, she actually believes that's more like a 40% increase in efficiency. Now, Cathie also reiterated her belief in Bitcoin, suggesting that energy costs are a non-issue relative to the traditional banking system, which uses a lot of energy, or even compared to the energy it takes to mine gold, for example. And she does view Bitcoin as a digital gold. She believes the use cases for Bitcoin are just beginning, and even though Bitcoin might be a little bit slower than smart contracts at Ethereum, she believes Bitcoin is the safest cryptocurrency there is. And she basically went on to call, and she didn't because Cathie was very nice, but she kind of basically went on to call Janet Yellen a boomer and kind of suggested that Janet Yellen doesn't really understand what the heck she's talking about with Bitcoin yet. And don't you worry, Bitcoin's still going to $400,000. Now, all of this could have just been the biggest defense for Cathie Wood, and maybe I'm just perpetuating that defense. I don't invest in Cathie Wood's funds, but, I tend to agree with a lot of her perspectives. I'm a little bit more on the side that we're not going to see inflation as quickly. I'm kind of on the side that we're going to have this frugal decade and see less velocity of money. Could be wrong there, but then again, I would say I'm like 80-20, 80% leaning towards less inflation, 20% keeping the door open. And we'll see, that can change over time. And of course, Cathie Wood appears to be somewhere maybe closer to like 50-50 on that. Maybe she's even like, no, I'm like 60% the Fed's gonna raise rates sooner rather than later. She's kind of treading lightly there in terms of which side she's actually on. Not that it really matters. I mean, the slight differences don't matter. I think we're both still gonna be investing in genomics and tech because the sectors are freaking awesome and innovation. It's great. But yeah, there you have it. So this was either a fully detailed advertisement for ARK. I'm not sponsored or affiliated with ARK, in all transparency here. Or hopefully this was educational for you. And I want to know, do you agree with Cathie, or has she lost her mind? Is she missing something completely? And are we instead going to see a more reverse of what I've just described, where we see maybe a Peter Schiff style future where the Fed doesn't think about raising rates? The Fed actually can't raise rates. Instead, they need to print more money because the dollar is collapsing, and we have much larger economic issues because all of our wealth is relatively disappearing, unless of course we're trying to protect ourselves in the stock market or assets, but ideally not dollar denominated assets. But then again, now we're really opening Pandora's box, and I did just have a 2-hour interview with Peter Schiff, so I think I'm not doing that justice by talking about that for about 30 seconds at the end of a Cathie Wood video. Anywho, if you found this helpful, make sure to share, consider subscribing to the channel, and folks, we'll see you in the next one.